Before I tell you this story, let me give you a warning. If you care about your money, you need to hear this until the very end, because this isn't just about one man. This is about how fragile the market you trust really is. Welcome back to Ascend Your Mind, the channel where we uncover the hidden truths of money, markets, and fear itself. And today's story will make you question everything you thought was safe. Picture this. You're sitting at home with nothing more than a laptop, some trading software, and an unstable internet connection. You're not a Wall Street hotshot. You don't work for Goldman Sachs or JP Morgan. You're just a guy in his bedroom. And yet, in a single afternoon, your trades trigger one of the fastest and scariest market collapses in history. On May 6, 2010, the U.S. stock market lost nearly $1 trillion in market value within just 36 minutes. The Dow Jones plunged almost 1,000 points, the steepest intraday drop ever seen at the time. This event would later be called the flash crash. The man accused of sparking it wasn't a billionaire hedge fund manager or a shadowy cartel. It was Navinder Singh Sarao sitting in his modest home outside London. This story is about fragility, about how fear spreads faster than logic, and about how the global financial system can be shaken by the actions of just one person. Navinder was born in 1978, the son of Indian immigrants in the UK. He grew up in a modest neighborhood near Heathrow Airport. He had a gift for numbers, a natural ability to see patterns in markets the way others see patterns in music. He wasn't social, he wasn't flashy, he simply wanted to trade. Unlike Wall Street professionals with teams of analysts, Sarao traded alone from his parents' house. His setup was basic: a few monitors, some trading software, and his brain. To the outside world, he was a nobody. But inside that room, he was about to shake the foundations of global finance. His method was called spoofing. He placed massive buy or sell orders on futures markets tied to the S&P 500. These orders gave the illusion of heavy demand or supply. Other traders and algorithms saw the orders and reacted instantly, but Sarao never intended to fill them. At the last moment, he would cancel them. In the chaos, he would take the opposite side, capturing quick profits from the artificial moves he had created. On May 6, 2010, the timing was catastrophic. Global markets were already nervous. The European debt crisis was escalating. Greece was on the verge of default. Fear was in the air. Around 2:30 p.m., New York time, the market went haywire. The Dow plunged nearly 1,000 points in minutes. Procter & Gamble fell from $60 to $40. Accenture briefly traded at 1 cent before bouncing back. In 36 minutes, $1 trillion of market value vanished before most of it recovered. It was chaos. Traders on the floor were shouting. CNBC anchors panicked on live TV. Around the world, investors watched their screens, convinced the system was collapsing again just 2 years after 2008. And in the middle of it all was Navinder Sarao, calmly placing and canceling orders from his bedroom. The flash crash wasn't just about numbers, it was about psychology. For a few terrifying minutes, people realized how fragile markets had become, that a few lines of code or a single trader could spark a cascade of selling across the globe. What followed was a fear bubble. Investors asked, if this can happen once, what stops it from happening again? Years later, investigators traced Sarao's activity. In 2015, U.S. authorities charged him with 22 counts of fraud and market manipulation. Prosecutors said he manipulated futures markets over 250 days, earning about $40 million. The FBI called him the flash crash trader. The image was surreal: a lone trader in sweatpants accused of sparking a $1 trillion panic from his parents' house. If you're finding value in this story so far, make sure to like this video and subscribe to Ascend Your Mind so you never miss the next big lesson hidden in financial history. But was Sarao really the cause? Critics argued he was just a symptom, not the disease. By 2010, algorithms dominated Wall Street. Over 70% of trades were executed by computers. In such an environment, even a small distortion could trigger a chain reaction. Think of a tightly stretched rope. A tiny tug makes the whole rope shake. Sarao eventually pleaded guilty, but his case raised questions far larger than his actions. How could a single trader manipulate global markets? The answer lies in the speed and complexity of modern finance. Machines trade in microseconds. They react to signals before humans can blink. If one signal is false, the reaction cascades instantly. Stories like this are why we created this channel. Here at Ascend Your Mind, we go deeper than the headlines. We expose the patterns, the psychology, the fear bubbles forming under the surface. The flash crash also highlighted a darker truth. Regulators were behind the curve. The SEC and CFTC struggled to explain what had happened. Their initial reports blamed a large sell order, but that was incomplete. Only later did they focus on spoofing and high-frequency trading. For ordinary investors, this raised another fear. If regulators didn't understand the crash, how could they prevent the next one? But the flash crash did more than just shake Wall Street for half an hour. It exposed a reality that many investors had been ignoring. Markets are not designed to handle panic. They are designed to function smoothly when confidence is intact. But the moment that confidence breaks, the system shows its cracks. Think about the average investor watching that day. Many of them had just started to rebuild after the 2008 crisis. Retirement accounts had slowly recovered. Portfolios had been climbing back. And then, suddenly, in the span of minutes, blue-chip companies looked like they were collapsing into dust. For some, it felt like déjà vu, a repeat of 2008, only faster and scarier. Even though the market bounced back by the end of the day, the psychological damage lasted for years. Many investors pulled out entirely, convinced the system was rigged against them. The flash crash was not the only time fear exposed market fragility. History is full of similar moments. In 1987, Black Monday saw the Dow plunge 22% in a single day. In 1997, the Asian financial crisis spread like wildfire. In 2020, during the early weeks of the pandemic, U.S. markets hit limit down multiple times, halting trading to prevent total freefall. Different causes, but the same outcome. Fear overwhelms reason, and selling becomes a stampede. What ties these crashes together is the amplification effect. A small spark becomes a blaze because the system is wired to react instantly. In 1987, it was computer-driven portfolio insurance. In 2010, it was high-frequency algorithms and spoofing. In 2020, it was pandemic headlines colliding with algorithmic trading and ETFs dumping assets automatically. In every case, the structure of the market turned fear into fire. Sarao's spoofing may look small compared to billions traded every second a day, but his trades acted like a lever, nudging an already unstable system until it broke. His story shows how fragile the rope really was, stretched tight by leverage, speed, and psychology. The irony is that the flash crash also created winners. Some traders, especially those with lightning-fast algorithms, scooped up bargains during the collapse. Buying Procter & Gamble at $40 and selling minutes later at $60 was a fortune made in seconds. For them, the chaos was opportunity, but for millions of everyday investors, it was trauma. That split between insiders who profit from volatility and ordinary investors who panic is another reason fear bubbles inflate. Technology since then has only grown more dominant. By 2023, over 80% of U.S. equity trading was algorithmic. Artificial intelligence is now being layered on top. Markets move not just in milliseconds, but microseconds. The more machines dominate, the more sensitive the system becomes to glitches, errors, or manipulation. So that's the story of Navinder Singh Sarao, the flash crash trader, a man who showed that one person, one laptop, and one set of trades could ignite global panic. But the real story isn't about him. It's about us. It's about the markets we trust, the bubbles we inflate, and the fears we cannot control. If you want to stay ahead of the next collapse, subscribe to Ascend Your Mind right now. Hit the bell, because in the next episode, we'll break down the biggest crashes in history and how you can protect yourself before the next one strikes. Remember, the market is fragile, but knowledge is power. And here, we help you ascend your mind before the bubble bursts.